How is everybody doing this evening? My name is Bob Igino. Thank you so much for being here. I'm going to just wait a few minutes before we begin, just to let a couple more people kind of filter into the webinar. There's going to be a lot of information in this webinar. We're talking about interest rates, of which there are multiple interest rate futures contracts. And we're going to focus on one key one here, but we're going to cover a lot of them. So just give me a few minutes. In the meantime, remember that trading in futures and options carries substantial risk of loss and is not suitable for every investor. You're going to see that on every slide of this presentation. And that's for very good reason, because that substantial loss is very, very real. So you need to approach futures trading with a risk first sort of an attitude. Make sure you're not over leveraged. One of the great things about futures trading is the futures markets allow you to trade like an adult. They treat you like an adult, and they expect you to be responsible with margin and leverage like an adult would be. So again, I'm going to wait a few more minutes for people to come in. I'll go over those points one more time, and then we'll go ahead and get started. All right, I think we've got enough people in here to get started. Again, thank you all for being here. My name is Bob Iacchino. This webinar is brought to you by Plus500. We're going to do an in-depth overview of the key aspects of interest rate futures. I want to say again, trading in futures and options carries substantial risk of loss and is not suitable for every investor. You have to understand leverage and margin and not abuse it, not use it irresponsibly. That is the best way to trade. One of the things I really like about working with Plus500, it's a feature of their platform, is they allow you to trade and demo with live prices, and it is unlimited. The minute you sign up for a demo account, you get unlimited free live pricing. That is very, very rare in this industry. And a lot of people get false confidence in their systems and in their strategies because of delayed data. Whether you have financial television on up in the background or something else gives you a trigger subconsciously because you're on delayed data to exit a trade early or take a profit early, and then it switches around, you get sort of a false sense of confidence with delayed data. That free, unlimited, live demo environment is critical, and it also teaches you to be responsible with the leverage and the margin that futures allow you. So please, futures and options, substantial risk of loss. It's a very real thing. Let's get started with the interest rate presentation. So what are we going to cover today? We're going to cover what interest rates are. That may seem like a bit of a review for a lot of you, but it's necessary in order to make sure we cover bases. We want to do things responsibly here at Plus500. So we want to make sure that we're talking about the core of what an interest rate future is, and it's a future on interest rates. So let's make sure we explain that. Also, we're going to cover what kind of interest rate futures are available on the future side of things for you to trade, the different types, the different durations. Whenever I mention duration or you hear interest rate people talking about duration, that means the length of time of a particular interest rate asset or vehicle. So for example, a 10-year note, the duration of a 10-year note is right around 10 years. So that's what duration means. We're going to look at 10-year micro treasury yield futures very specifically. And the reason I chose that one is because yields are what you hear the financial world talking about. You don't hear them talking about the 30-year bond price or the 10-year note price or the 5-year or 2-year note price. You hear them talking about the yield. And the yield is really what applies in general macroeconomics. So we're going to look at that yield. We're also going to talk a little bit about margin and leverage, which I'm going to bore you guys with it, but it's just, you have to learn about it and you have to be responsible with it because, again, futures treat you like an adult. So they expect you to trade responsibly as an adult would by giving you all this margin and leverage to work with. And then we're going to look at the Plus500 platform, and we're going to cover a little bit of a case study here for a trade that I was looking at earlier, I should say late last week. So what are interest rates? Interest rates are the cost of borrowing money or the return on investment for lending money. So we call it the cost of money. Central banks set short-term interest rates. Markets set long-term interest rates. In the US, obviously, that's Federal Reserve. In Europe, that's the ECB. In the UK, it's the Bank of England. So what do I mean by short-term, long-term, and the market setting them versus the Fed setting them? Well, we've got a Fed meeting on December 7th. December 7th, the Fed will set the overnight Fed funds rate. That is what banks borrow money at. That's the rate a bank will borrow money. Why do the banks borrow money? They get money from us. Why do they need to borrow? Because they have reserve requirements. Every night when a bank closes, they need a certain amount of money in reserve in their coffers. That is set by regulation by the Federal Reserve. But obviously, they lend to us. When we go to borrow for a mortgage or for a car, we borrow it, let's just say for the sake of the conversation, from banks. So they don't necessarily have the money that you put in your savings account in their vault. They lend that money out. So they borrow every single night from the Fed in order to keep their reserve requirement on a nightly basis where it should be. So that essentially means that they borrow in very short term and they lend very long term. Okay, what's long term? 5-year, 10-year, 30-year. When you get a mortgage, you can get a 15-year mortgage, a 30-year mortgage. You get that from a bank. They've lent it to you over that time. So when we talk about a yield curve, we're talking about a normal shape yield curve. The short end of the yield curve, the overnight rate, the 2-year note, for example, into the shorter curves, that's what the Fed has an effect on. But when you're talking about 10-year notes and 30-year bonds, the Fed has almost no effect on that. If they cut rates, you may see the 10-year yield go lower. You may see the 30-year yield go lower, but that's because the curve moves all at once. The market sets the yield on the longer duration assets, the 10-year and the 30-year, by gauging where it thinks inflation is going to be. All right, now there's common types of rates. Nominal rates, which is the rate that's stated. So if you're looking at a 10-year yield, for example, at 4.30%, that's the nominal rate. Real rate is the nominal rate minus the rate of inflation. Why do we call that the real rate? Well, if you've lent money to the US government for 10 years and inflation averages 1% and you've gotten a 4% yield, at the end of that 10 years, you're going to have a difference between the rate of inflation, let's say it's 2.8%, and your 4% per year that you made on your 10-year. So your real rate is 1.2%, the difference between inflation and the rate you got paid. Your dollars are either worth more or less based on whether we're in an inflationary environment or a deflationary environment. The Fed's role is very specific. They control short-term interest rates, and they do that to attempt to maintain economic stability. You've all heard of this dual mandate that the Fed has: price stability, which is the price of goods, that's inflation, and employment. They're supposed to try and keep the unemployment rate somewhere near full employment. For the sake of conversation, full employment is about 4.2%. That's what the Fed considers it to be. So right now, we're at about 4.2%. This coming Friday, we're going to have another non-farm payrolls number. We'll see where that unemployment rate is. The rate banks charge each other for overnight lending is the federal funds rate that I just described to you. And they have monetary policy tools like open market operations, discount rate adjustments, and reserve requirements. I mentioned some of those a few minutes ago. You don't really have to go too deep in the weeds on those. You just need to understand that what the Fed controls is the very, very short end of the Treasury yield curve, 2-year and lower. So 2 years, 1-year bill, 6-month bill, 3-month bill, 1-month bill. That's what the Fed affects when they cut rates or hike rates. And the rest of the curve adjusts based on what they think the Fed funds rate will do to inflation, to the value of money in the future. When we talk about interest rates, we're talking about interest rates having an effect on the economy. Raising rates, that's the Fed raising rates, is an attempt to cool down inflation. Now, how does it do that? Well, if interest rates are higher for the banks to borrow, that means they lend to you at a higher interest rate. We've all seen this in the current housing market in the US. As the Fed was raising rates, prices on houses stopped going higher and people stopped buying houses. Why? Because the interest they had to pay on that mortgage went higher. So that means less money flow. Okay, there's fewer people buying houses, there's less money going into the pocket of people selling houses, and there's less money to spend. So lowering rates is an attempt to boost consumer spending and investment. It's the opposite of what I just described. If the Fed starts lowering rates, they're trying to make money cheaper for businesses and consumer to borrow and spend. That's the effect of that. Employment. Low rates stimulate job creation as businesses invest and hire more. Again, if you can borrow money at lower rates, for example, a lot of companies use credit lines to pay their payroll. Okay, they produce products or they provide a service and they're waiting to get paid for that. Okay, if I provide a service to a company, I send them an invoice and then I wait to get paid. But I can't wait to pay my employees, right? So I use a credit line at the bank and I borrow against the money in that credit line. I pay my employees, I pay an interest rate on that, and then I have to figure that in to what I'm going to charge my clients so that I cover all of my costs. There's a float there, a difference between the two. So lower rates stimulates business to hire more people because if they have a lower rate on their credit line, they can afford to hire more, and vice versa if rates are higher. And then, of course, economic growth. Lower interest rates make credit cheaper, spurring investment and consumption, leading to higher GDP growth. Before I go on to the next slide, I want to remind you guys there is a question function here. If you guys want to ask questions, you can go ahead and put your questions in that chat. We'll get to them at the end here. Higher interest rates slow economic activity to prevent overheating. Same concept. As interest rates go higher, a business with a credit line who pays their employees from that credit line, they're now paying a higher interest rate on that borrowing, and they may hire fewer people because it makes them hiring people is more expensive than it was in the past. Interest rate futures. So what are interest rate futures? They're futures contracts that derive their value from interest rates, and they're tied to specific products like government bonds, T-bills, interbank lending rates. We're not really going to cover that interbank lending too much today. Traders use them to hedge against or speculate on interest rate fluctuations. As you've seen lately, interest rates move and they move a lot. We've seen the 10-year over the last year go from the low 3% to the mid 4% level. If you go back even further than that, we've seen a 10-year yield just around 1% and then go all the way to almost 4.5% by the end of this year. They move a lot. Banks, pension funds, and insurance companies are the key players on the institutional side of interest rate futures. But retail trades them a lot now that you have the inception of the micro futures. So let's go through just on a name basis the interest rate category on your Plus500 futures platform. You have a 2-year note that you can trade, a 5-year T note, a 10-year T note, a micro ultra 10-year Treasury note, a U.S. T bond, an ultra T bond, a micro ultra T bond, a micro 10-year yield contract, 30-day Fed funds, ultra 10-year note yield, and a 3-year T note. T note just stands for Treasury notes, so that you guys know. The question I usually get with this is, what's the difference between the 10-year note and the ultra 10-year note, or the bond and the ultra bond? It really is the underlying contract that the contract settles to. So if you're going to be trading these things, I personally would recommend the ultra. So for example, the ultra 10-year note has a duration of a little bit over 9 years. So the underlying contract is closer to being a 10-year bond than the regular T note is. The T note settles through a process called cheapest to deliver, and that's just something we don't need to go into here. So if I were you guys and you wanted to trade the actual contract, I'd really focus on the ultras. I think those are the better contracts for you guys. But for the purposes of this, let's look at the 10-year micro treasury yield futures contract. So why am I pointing you to this? As I mentioned earlier, when you hear people talk about finance and macroeconomics, you'll hear them talk about the yield, not the price. The relationship with interest rates between price and yield is if price goes up, yield is going down. And if price goes down, yield is going up. Why is that? Well, the best way to visualize that really is you have a yield here and the price is kind of in the middle. So the yield plus the price move makes the actual tradable yield. So if the price is going lower, that means we're getting further away from what they call the coupon, and that means the yield is getting higher. If the price is going higher, we're getting further away in the opposite direction from the yield. So that means the yield is going lower. If you were to pay for an existing bond that, let's say, has a 4% coupon, time has already passed and those coupon payments have already been paid in part. So there should be a discount because if you're buying that from somebody, they've already received some of those coupon payments. You're not going to receive the full coupon payments unless the interest rate on the new stuff is a lot lower, in which case you're going to be receiving a higher coupon of the already existing bond. I don't want to get too far in the weeds about that, but this is why I point to the yield futures contract as the easiest way to understand it. I personally keep an Excel spreadsheet that I've been keeping for multiple years. If I scroll on my computer, you'll see that the yields just go and go and go and go. And I mark down the daily closing yield on all the different contracts, starting with the 3-month, going out to the 30-year bond. And you see the yield change every single day. The futures contract, the yield futures contract, is the easiest one to understand because of that. If you'd rather trade the prices, understand that you have to understand the tick value of the prices. And when you look at a platform, those are the decimals of the tick value fractions that have been calculated out for you. So Plus500 does that for you, and it's very, very convenient. The 10-year micro treasury yield futures contract allows traders to speculate or hedge interest rate movements at the 10-year point in the U.S. Treasury yield curve. These contracts are cash settled and represent a smaller size, more accessible alternative to the standard 10-year futures. Let's talk about this for a second. When you're looking at yield movements, okay, you're looking at the macro view of things. So for example, if all of a sudden you see a series of CPI figures that are higher than they were or higher than expected, you're likely going to see a higher 10-year yield. If you see CPI or other price data like PCE or maybe the ISM price component, which came out earlier this morning, they're likely, you see those shrink or go into more of a disinflationary or deflationary trend, you're likely to see lower 10-year yields. The 10-year yield to me is the perfect spot of the curve for retail traders to be looking at because they apply to mortgages, they apply to car loans, they apply to a certain degree to credit card interest rates. The 10-year is almost the midpoint of the whole Treasury futures curve, and it's almost the fulcrum by which the other ones turn on. So the 10-year yield moving is likely pulling the entire curve in one direction. So therefore, it's easier to look at and say, okay, yields are going higher because the 10-year yield went higher, or yields are going lower because the 10-year yield went lower. You could conceptually see a situation where the 2-year note yield goes lower, the 30-year note yield goes higher, and the yield curve is shifting dramatically, but the 10-year is probably doing the more dominant movement. In other words, if the 2-year yield is going lower, the 30-year is going higher, but the 10-year is going higher, you can make a blanket statement that yields are, for the most part, going higher. So the 10-year yield is a much more effective one for you guys to look at. So let's look at contract specifications of the 10-year micro, all right? The key specifications are the contract unit. It reflects 1/10 the standard Treasury futures contract because it's a micro. That's pretty typical of micros. Cash settled, settled to the BrokerTec U.S. Treasury yield benchmark, okay? Cash settled is very important for you guys at this stage in your trading. You don't want to be in a deliverable contract unless you specialized in this in the past. The expiration, you usually have the closest to monthly contracts that are typically available for trading. My recommendation, this is my personal recommendation, stick with the front month. It's going to be the most liquid. And then in terms of the dollar value of a basis point, you guys understand what a basis point is? If you're looking at a 50 basis point cut by the Fed, it's 0.5%. Okay, so 100 basis points is 1%, 50 basis points is 0.5%, 25 basis points is 0.25%. So if I see the 10-year yield move from 430 to 420, it has fallen 10 basis points. Okay, and the value of that basis point on the micro is $10. Now, that is not the tick value. Okay, the tick size represents the minimum price movement allowed in the trading of futures contracts. Okay, the tick size is 1/10 of 1 basis point in yield. So 1 basis point is 0.01. That's why when you look at your Plus 500 platform, it's going to go out 3 decimal points. Okay, so for example, the other day, I sold a micro yield contract at 4.393. Okay, so when it went there, I was putting on a short position, and it went from 4.393 to 4.392, it moved 1 tick or $1. When it went from 4.393 to 4.293, it moved 10 basis points or $10. Just to give you guys a mathematical example, I bought that back at 4.346 for a gain of 47 ticks. Okay, 4.393 minus 4.346 is 47 ticks times $1, that's $47 minus about $1.62 or so in brokerage, ended up with $43 in change profit. Okay, that's a mathematical example of what I did. So remember, it goes out 3 basis points because that farthest out one is the minimum tick movement. The small tick size makes the contract accessible for retail and institutional traders. All right, the tick example, I already gave it to you. Here's another one. If a trader shorted the CME micro 10-year futures contract at 364, that's 3.640. Remember that third decimal point. And the yield contract dropped to 3.20, that's 3.200. The trader would profit $44 per micro. Okay, so that's how much that is per micro contract. I'm sorry, 440, because that's the difference. It's 440 ticks, and it's $1 per tick. That's a pretty big move, 3.64 to 3.20, but that's probably not going to happen in a day, just so you guys know. The small tick size makes the contract accessible for retail and institutional traders. All right. So I talked to you guys about margin and leverage. The margin requirement for a 10-year micro treasury yield futures are lower compared to the standard contract, allowing traders to leverage their position more efficiently. The lower capital requirement makes this product appealing to a wide range of investors, including retail investors and traders. Let's talk about some of the market moving events that could potentially move this 10-year. I touched on this a little bit, but they're listed out here, so it's easier for you guys. Federal Reserve interest rate decisions, or the presumption that a change in a decision is coming. So for example, Fed press conference, we got a meeting coming up December 7th. There'll be a press conference. There'll also be a statement. The 10-year could move on a change in the statement after a Federal Reserve interest rate decision that resulted in no interest rate change. U.S. inflation reports, CPI, PPI, PCE, some of the price components in the ISM PMI data, non-farm payrolls and other employment data. Remember, the Fed has a mandate of price stability and full employment. So if we have a big change in non-farm payrolls and the employment component of that, the unemployment rate was 4.2% last, I think. That could cause the Fed to change a direction, which would cause movement in the 10-year micro treasury yield, probably along with a lot of the other interest rate products as well. and U.S. Treasury auctions. This is an interesting one. U.S. Treasury auctions, it's a bit of an acquired skill, but I'll give you one tip on that. You're going to want to look at the bid to cover ratio. So there's bidding in the U.S. Treasury auctions, and then there's the amount of those bids that get allotted the new treasuries. That's called the bid to cover ratio. The easiest way to look at that is anything over 2.5 is generally regarded as a good auction. Anything below 2.5 is regarded as a weaker auction. And you guys can just Google after an auction happens, what was the bid to cover ratio? It's pretty easy to find. Advantages of the micro treasury yield contract: precise exposure to the changes in the 10-year point of the U.S. Treasury yield curve. Again, I already described what the value of that 10-year point in the curve is. Again, it's kind of that fulcrum. It's also the place where a lot of people, when you hear about yield curve inversions, people are usually talking about the 2-year to the 10-year. I'll go into that probably in another webinar. And just so you guys know, this is number 1 in a series of 10 webinars where I'm going to be talking about other things. I believe our next one is Bitcoin futures. So you guys can come into those with questions as well. Or if you want to reach out to Plus500 to send me some questions I can address in a future webinar, I'm happy to do that as well. Key benefits of trading 10-year micro treasury yield futures include lower capital requirements, cash settlement, and flexible risk management and speculative opportunities. Speculating in treasury futures is a really good place to start. As a matter of fact, in the professional trading world where I spent a lot of years, I've been doing this 30 years. I spent 9 years at a hedge fund. I spent 13 years at a futures firm. I spent 6 years at a prop firm. A lot of the times with beginning traders, they start you with interest rate futures. They'll start you on that because they don't necessarily always move as quickly. They don't move on every single piece of economic data. They move a little bit. During the cash session, most recently, we saw a 9 basis point move, okay, which would be 90 ticks in the Treasury micro futures on the 10-year. So that's not massive when you're talking about $1 a tick. You're talking about a $90 move. If you entered at the worst possible place and got out at the worst possible place, most people can manage that. So this is a really, really, really good place to start. And I'll go over in a little bit why the Plus500 platform is also a really good place to start. Risks to consider: leverage can magnify losses if the market moves against the position. Again, this is part of the reason that you see a lot of futures traders, when they start their career, they start trading in interest rates. Fun fact, when I started as a clerk on the floor of the Chicago Mercantile Exchange, I was in the interest rate futures. Sensitivity to macroeconomics requires active monitoring, so make sure you use stops. With the micro contract, you're not likely to blow up your account, but stops are still, to me, the number one thing traders have to use. If I'm teaching a trader to trade and they say that they're not going to use stops, I immediately end the relationship. I will not continue a relationship if a trader is not going to use stops, because what happens most of the time is you forget, number one, you forget to put your stop loss order in. If, say, you're going to use mental stops or you're going to exit a position once a particular price level is hit, you forget to do it. And then the biggest, most important point is a lot of the times you'll extend your risk. The only time you're thinking clearly about a position is before you're in it. So when you force yourself to use stops on a position immediately, and Plus500 has a very good system where they have your stop order is right there, right in front of your face on the trade ticket. So try to get in the habit of putting your stop order in right away, because you'll end up expanding your risk on what we call the hope trade. The trade's going against you and you're hoping it won't, so you don't put a stop in, or you put it in at a different place than the designated stop area you decided prior to entering the trade. The only time you're thinking clearly about a trade is before you're in it. Liquidity risk can arise during times of market stress, although that's generally low in the interest rate futures. All right. Let's take a look at a case study on the Plus500 platform really quick. This will be something that I've actually looked at before. All right, so we got a Plus500 demo platform here. You can see I've got the micro yield chart up. All right, first let's give you a look at when you click on interest rates. Here is the list of all the different interest rates that I mentioned during the presentation. Okay, let's go ahead and pull this up, and I want to show you something. What I'm looking at is an hourly chart here. I've got my particular indicators, the way I look at a chart, up on this screen right now. And what I've got here is I've got the 8 exponential moving average, and I've got the 21 exponential moving average. The 8 and the 21 is what I call the rotation zone, okay? I've also got a 10-day RSI right over here, and I've got volume, okay? So what I like to do is I like to look for a move into my rotation zone that then turns around and moves back lower. So what constitute a rotation zone? Well, again, it's the 8 and the 21. Actually, this is the 14. I want to change that. This has to be a 21. All right. So what I like to see here is the 8 and the 21 have crossed, and they've started to widen out and move in an angular direction, okay, either plus or minus. All right, this case where I'm pointing to right here, it's moving lower. So what I would look at as I see the market moving up into this area, I'm going to draw what I call a best fit trend line here, okay? So I'm going to go over to my drawing tools, I'll pull those up, and I'll pull up any one's fine, a trend line, array, whatever you want to use. And I'm going to draw this here in just sort of a best fit, okay? And what I do then is I wait for a close below that best fit trend line. And I got that close right here. And this would be the trigger for me to enter a short trade, okay? So as soon as I get a close below that, you can anticipate it and get in it sooner than that if you'd like to. I'm also going to find my stop is going to be above the most recent high of the move into the rotation zone. So above this area here. And then I've also got a past low here. So I'm going to put my stop somewhere right around here above this 21-day exponential here. All right. Now, when I put it above there, that's going to protect me on the downside. Now, how do I find a target? Well, I find a target with Fibonacci extensions, which you've got that tool right here. All right. So what I'm going to do is I'm going to go from a low to a high. I'm sorry, I'm drawing that wrong. Scratch that for a second there, guys. Let me just get rid of this. Sorry about the quiet here for a second. So I'm going to go from a high, which is up here, to a low, to another high, which is going to be right here. I'm not going to this high here because this high hadn't happened yet, right? This is the entry. And what I'm going to do is I'm going to look for the 61.8 retracement extension. Okay, so you sell it here, and my target is going to be the 61.8 retracement extension, which is this last sell price, or this red line right here. And that's going to be my target. That's how I would have traded this particular pattern right here. Now, this is not the one that I told you about the other day. That was a little bit older than this. This has an entry planned out to close below here, a stop planned out right in the range of this green line, and a target that I got from this high to this low to this high with the Fibonacci projection tool on your Plus500 platform. That's the way I would enter this particular trade, looking for lower yields on here. Again, this is the micro treasury yield. This is an hourly chart. That's how I would have set that up. All right, guys, I'm going to end this. I'm going to stop sharing here. Hopefully you guys have a great day. You guys enjoy the rest of your week. And I'm easy to find. You can find me on Twitter. You can reach out to me through Plus500 if you want to, if you have any further questions. Guys, thank you for being here. I really, really appreciate you taking the time. Remember the risk. Remember to check this out on YouTube later, and I will see you guys in the next one. Remember, this is a series of webinars, so make sure you pay attention, watch your emails for our next webinar. Cheers, guys.